This video is about how to increase your business valuation before raising capital. Two founders raise the same amount of capital. One gives up 10% of the company, the other gives up 25%. The difference is not luck, it is valuation. If you are preparing to raise capital, whether you are at idea stage or generating revenue, understanding what actually increases valuation can significantly change your outcome. In this video, we'll break down the core drivers that influence how investors and acquirers assess value, and what you can do to strengthen them. The core principle. Before discussing tactics, understand this. Valuation increases when expected, future returns increase, and when perceived risk decreases. Investors price businesses based on future cash flow potential, adjusted for uncertainty. So there are two primary levers. 1. Increase expected future performance. 2. Reduce perceived risk. The strongest valuations achieve both. What if you are pre-revenue? If you are at idea or pre-revenue stage, the same principles apply. But the evidence looks different. Instead of historical revenue, investors evaluate early traction or user growth, pilot customers or letters of intent, product validation, market demand signals, founder experience and credibility, size of the addressable market. Instead of improving profit margins, you focus on clear unit economics assumptions, logical pricing strategy, realistic go-to-market execution. At early stage, valuation is driven less by financial history and more by milestone achievement and execution confidence. The goal is still the same: increase future potential, reduce perceived risk. The signals simply differ. 1. Revenue growth rate. For revenue-generating businesses, growth is one of the most powerful valuation drivers. A company growing at 70% annually is valued very differently from one growing at 10%, even if revenue today is identical. Why? Because future scale drives future returns. Example: Company A generates $1 million growing at 15%. Company B generates $1 million growing at 80%. Company B will likely command a significantly higher multiple due to projected expansion. Improving valuation here means accelerating customer acquisition, expanding into new markets, increasing pricing power, improving sales conversion. Growth signals opportunity. 2. Profitability and margin. Quality revenue alone is not enough. Margin strength determines the quality of revenue. High gross margins suggest scalability and pricing power. Strong operating margins demonstrate operational discipline. Two companies with identical revenue can have very different valuations if one operates at 10% margins and the other at 35%. Improving valuation here means reducing cost of goods sold, optimizing operating expenses, automating processes, improving supplier terms. Investors value sustainable, scalable earnings. 3. Predictability and recurring revenue. Predictability reduces risk. Subscription models, long-term contracts, and repeat customer behavior increase valuation multiples because they improve forecasting reliability. A business with recurring revenue is typically valued more highly than one dependent on irregular project income. Improving valuation here means introducing recurring pricing models, securing longer-term agreements, improving retention rates, reducing churn. Stability increases confidence. 4. Customer diversification. Customer concentration risk reduces valuation. If a single client represents 40 or 50% of revenue, risk is elevated. Losing that client would materially impact performance. Improving valuation here means diversifying your client base, expanding across sectors or geographies, reducing reliance on one contract. Diversification lowers perceived volatility. 5. Market size and positioning. Investors evaluate your total addressable market. A business in a small, constrained market faces valuation ceilings. A business operating in a large, expanding market can justify higher growth assumptions. Improving valuation here means demonstrating credible market expansion, showing clear positioning, articulating competitive differentiation, supporting claims with market data. Market opportunity drives long-term projections. 6. Competitive advantage and defensibility. What protects your business from competitors? Examples include intellectual property, proprietary technology, regulatory licenses, strong brand positioning, network effects, switching costs. A business that can easily be replicated will be valued lower than one with structural protection. Defensibility reduces long-term risk. 7. Management team. Strength. Investors invest in teams. A strong leadership team reduces execution risk. If the company depends entirely on one founder, valuation may be constrained due to key person dependency. Improving valuation here means building leadership depth, hiring experienced operators, strengthening advisory board, distributing operational responsibility. Execution confidence directly impacts valuation. 8. Financial clarity and transparency. Clear, structured financial reporting increases credibility. Disorganized accounting reduces trust and increases perceived risk. Professional investors expect accurate financial statements, clear revenue segmentation, transparent cost breakdown, realistic projections. Clarity supports defensibility. 9. Legal and structural stability. Unresolved legal issues, unclear shareholder agreements, or poorly structured equity can negatively affect valuation. Before fundraising or exit, review shareholder agreements, clarify cap table, ensure regulatory compliance, resolve outstanding disputes. Structural stability reduces friction in transactions. Bringing it together. Improving valuation is not about artificially inflating numbers. It is about strengthening fundamentals. When growth becomes more credible and risk becomes more controlled, valuation improves naturally. The strongest founders prepare their valuation drivers before entering negotiations. They do not leave it to investors to define their worth. Practical example. Consider two companies generating $2 million in revenue. Company A, 20% growth, low margins, high customer concentration, informal reporting, limited management depth. Company B, 60% growth, strong margins, diversified clients, clear financial reporting, experienced leadership. Even with identical revenue, Company B will likely command a higher multiple. Valuation reflects quality, sustainability, scalability, and risk profile, not just size. Final thoughts. Valuation is a reflection of how attractive and defensible your business appears to capital providers. Whether you are pre-revenue or scaling globally, the principle remains the same: increase future potential, reduce perceived risk. If you would like to understand how these drivers influence your own valuation, you can try the free business valuation calculator at www.valuation4u.com. And if this video was helpful, subscribe for more practical guidance on business valuation, fundraising, and strategic finance.